Here's another run through of the top 5 charts of the week. Again, if you wanted to read about the first 2 years in business of top-down charts, I've got a link here to a blog post that I wrote just reflecting on top-down charts turning 2 years old. But anyway, let's look at the charts. The first one is the S&P 500 against cumulative US equity fund flows. This is both mutual funds and ETFs in the blue line there, and it's cumulative from the beginning of 2013 there, which is actually the beginning of the higher frequency data there on data stream. But anyway, look, there's a pretty interesting pattern here. Especially more recently, you got the S&P 500 generally heading upwards, and particularly heading up out of the corrections. And then you've got fund flows, cumulative fund flows, just tapering off, if not heading down somewhat. So it's quite an interesting divergence. We did see something kind of similar back in 2016. So just after the 2015 and 2016 twin corrections there. I mean, generally whenever you get market volatility, you tend to see fund outflows. It's just human nature. People tend to react, and they tend to be buying when things are rising and selling when things are falling. And anyway, in the wake of those two corrections, you saw fund flows, cumulative fund flows, quite distinctly tapering off there, falling for quite a while. And after that second correction, stock prices pretty much heading upwards. The exception there is that little dip down, which was Brexit, and that other little dip down there, which was the election, which, obviously in hindsight turned out to be a bit of a turning point. But out of that, little period of divergence there came a pretty significant, substantial upward move in price. So, if you were wanting to look at the one single example that we have in this chart and try and extrapolate it to what we're looking at now, then maybe you say, well, because investors are, clearly acting slightly cautious here at the moment, then there is scope or a bit of fuel for prices to actually head higher, even from here. Of course, the counter argument to that would be that this is actually smarter money flows, and that the market's on borrowed time. But what we can say at least is that investors are not throwing caution to the wind. They're not piling in, and we'll leave it at that for now. Second one here is for China property versus stock market prices. So in the lighter blue line, we've got property prices, and this is up to August, so it's the latest data. And you can see that there's this re-acceleration in property price growth. And that's in contrast to the fall, or steadily worse returns for Chinese equities, and that actually was made even worse with the announcement of the new tariffs. But there's an interesting sort of dynamic or phenomenon that you see if you study Chinese asset markets. So if you think about the Chinese financial system, Chinese capital markets, for the most part, Chinese investors can only really invest domestically. Now this is changing very slowly, gradually, and the authorities there always talk about opening up, and it tends to be, they're definitely moving in that direction, but if you looked at it day to day or year to year, you'd say that they're making pretty slow progress, that it's more talk than anything. But that's another issue. The point that I want to make here is that you see this sort of running from one asset to another, because obviously if all the speculative money, the hot flows are kind of trapped within the country, then you're going to see this sort of merry-go-round effect where they, the marginal speculative investment dollar chases gold, then it chases wealth management products, then it chases property, then it chases the stock market, and then it goes back into property. And we can see this here on this chart, So when the property market came under pressure in 2014-15, we actually saw quite a rotation out of property and into the stock market. I think that was actually a key driver of the initial, at least the initial phase of that stock market bubble there that we saw in 2015. And then when that bubble burst, you actually kind of had that rotation back out of stocks into property, and seems like we're getting another rotation here again as investors are basically saying stocks are too hard in the meantime because of the trade wars, etc. Property's a pretty safe bet, especially if the government's going to stimulate, going to make money cheaper, and that's going to make it easier to make money out of property. So it's quite an interesting chart, and it's in contrast to my previously bearish view on the outlook for a Chinese property market. And so it's quite an interesting dynamic here, bit of animal spirits thrown into the mix. And if it continues, if it's not just a one-off sort of blip, then we're going to have to start talking about upside risk for commodities and emerging markets. And that's a good way to move into the next few charts, which are all talking about emerging markets. So number 3 here is S&P 500 versus MSCI Emerging Markets Index. You can see that we've got this parabolic move, mostly driven by EM crapping the bed, but S&P 500 has done decent, at least in the second wave there. And what's driving this? Well, EM equities have come under stress, under pressure, because you've had multiple headwinds really. Stronger US dollar, Fed tightening, Fed QT, the trade war issue, slowing growth in China, pretty much a bit of a perfect squall or perfect mini storm that has beset the emerging markets. Yet for America, valuations are clearly a concern, because you look at valuations for the S&P 500 and they're not cheap. But then you've got this the pretty solid earnings trend, and part of that is just down to the decent domestic growth, but obviously the tax cuts are a big thing, prospect of potentially another wave of tax cuts. And so, it's basically been a capitulation on the relative value trade, because emerging markets were trading relatively cheap versus US equities, and of course now they're trading even more cheaper. So there was this pretty heavy overweight to emerging markets amongst fund managers, and also pretty decent underweight to S&P 500 as well, and so that's kind of been unwound, and that's been a big driver behind that as well, adding fuel to that. On to number 4. So speaking of valuations, so I just talked about the relative valuation picture, but this is kind of the absolute valuation picture. So EM equities valuations against their own history. This is a blended PE ratio, so this is a combination of the PE10 or CAPE, which is price versus trailing 10-year earnings. It's also including price to next 12 months earnings and price to last 12 months earnings. So the point of that is just to bring together multiple signals, give each of them a vote, so that you get more signal and less noise. And the signal that we're getting here is that EM equities, going back to 2016 again, very cheap at that point, basically triggering a buy signal. If you looked at the SD bands, standard deviation bands, as a sort of a very rough means of producing buy and sell signals. Big turnaround there since then. And then after going slightly expensive, I guess you could call that, just on the slightly expensive side of the long-term average, we have seen quite a decent reset there. So it's one to be mindful of. I think that the headwinds for emerging market equities are still in place. So, we have seen improvement there. Maybe we see more improvement if those headwinds persist. And last one is looking at emerging market equities as a proportion of global equity market capitalization. I think this is quite an interesting chart really because, well, there's a few things going on here. The first one is just to compare and contrast that EM equities only account for just under 15% of global equity market cap, yet in GDP terms, EM economies account for more than 55% of world GDP. So that's quite an interesting juxtaposition there, really. And I would expect that that would close, the gap between those two figures would close over the long run. And so this long-term upward trend that we're seeing here is probably going to continue. But with all trends in markets and economies, you also get a cycle around the trend. And what we're seeing here is we saw that cyclical uptick, and then it's come back down. I mean, even with that decent performance there and then a bit of a correction lately, it hasn't really moved the dial that much. Went above 15, back below 15 now. So it's quite an interesting chart really. It's the cycles around that trend, can give you a bit of information about what's going on in terms of sentiment and cycles, and definitely what opportunities there are in terms of actively allocating. But then it also highlights this potential further to run for the whole, sort of structural themes with emerging markets, the rise of emerging markets. So quite a good, interesting way to cap off this sort of series of emerging market charts. If you have any questions or comments, put them in the comment section of the YouTube video. Otherwise, subscribe to the channel so that you get updates when I put out a new video.